Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome back into another edition of the podcast. It's Phil's Tax Hacks and Other Retirement Facts with Phil and myself. And Phil, we're going to talk about analyzing advice on surviving a bear market. We're in it. We're in it in different places. We got some stuff going on. Lots of turmoil. The R word, recession's out there, getting thrown around daily. Now, we did have a pretty nice bounce back at the time we're taping this. Let me pull this up. Last Friday, it bounced back pretty nicely. We're taping these on Tuesdays usually. Got us back over the 31,000. We're up a little bit today, but around 31.5 on the Dow.
Yep.
As we talk about it. So, it's picked back up a little bit, but obviously still a lot of turmoil, right? A lot of volatility.
Yeah, absolutely. Yeah. There's still a lot of unanswered pieces out there in this. How is it all going to play out?
So we've collected some advice from some experts that are not us.
Yeah.
I am not an expert. You've been doing this for 30 plus years, so you certainly have a lot more information, which is why we do this show and talk about things. But you might have heard some of this advice yourself, Phil. You might agree with it. You might not. So I'm going to go through with it and see what some of the big talking heads have to say. Follow it, proceed with caution, that kind of thing, right?
Yeah.
So we'll jump in and just kind of run through a few of these here. We've got an equity strategist named Phil Orlando. I'm not sure exactly what an equity strategist is. Maybe you can explain that for us too. It says he expects the market to decline further over the summer, perhaps on another 10%. He expects it to fall, and that he favors value stocks, energy, financial, healthcare industries over growth stocks. Also says holding cash hasn't been this attractive in more than 20 years. That's kind of a no-brainer though, because the interest rates are ticking up. So I don't know, nothing really groundbreaking there. I kind of agree with Phil a little bit here. Phil?
Yeah, I mean, it's to some extent I do. I mean, it's so the whole, could it decline another 10% over the summer? Who knows where we're at in this bear market?
Sure.
We broke that bear market barrier on the S&P. NASDAQ's been there. Dow hasn't quite made it yet.
It's close, right?
It's close, but personally, I don't think it's over. I think we've still got a ways to go. There's a lot of unanswered pieces yet to this whole puzzle. Inflation, we still don't have it under control. The Fed's really starting to push hard with, raising interest rates.
Yep.
So could it decline another 10%? Absolutely. I mean, looking at historical,
I think it's probably reasonable. It's probably reasonable.
I think it could go way beyond that. If you look at kind of more traditional bear markets, I mean, just breaking that bear of 20%, where could it go? I mean, we could be down 40, 50%. I don't think would be
that scares folks, man.
Unrealistic, but I mean, that's or unreasonable. But I mean, that's what happens in a bear market, and summertime typically is not a good time for stocks. I mean, historically, there's even a strategy out there, the whole sell in May, go away, come back again on Thanksgiving Day, so kind of a rhyme, but I mean, there's a strategy around it. You sell in May, last day of May, you don't invest at all in the summer. You come back around Thanksgiving because fourth quarter is typically really good.
True.
Companies are making their financials look good for wrapping up year end,
Christmas sales,
we get into Christmas time, right? The holiday sales. I mean, there's a lot of things behind that fourth quarter. Typically is a good quarter. So
what do you think about the value stocks and the growth stock pit?
I would agree with him just because growth has had its run. I mean, that's what's carried us over the last, 5-10 years, at least 5, definitely out of the pandemic. I mean, they're the ones that just boomed.
Yeah.
Value is started to pick up. But again, I mean, any equities stocks in a bear market, are going to fall, maybe not quite as much. And we've already seen
that. Yeah. Tech has been taking a beating. Yeah.
Absolutely. Even to this point, those growth stocks have fallen significantly. Value was holding its own and doing really well until recently.
Okay.
So it only started to fall probably in the last month. But it's still not down as far as growth was, but growth, far exceeded what value did in prior years. So, I mean, it's that reversion to the mean concept, right? Growth took off, so it's going to fall harder. At this stage, value didn't grow quite as much, so it hasn't fallen as far. But
And that's the point of diversification conversation that we took.
Absolutely.
Right. Exactly.
Yeah. I mean, you might overweight or underweight kind of depending on what's going on, but don't chase the winners all the time, right? If growth is going, everyone throws all their money into growth stocks. And
which is what we've been doing the last couple of years.
Be very careful, because that's a recipe for disaster.
Yeah,
because everything comes back. It reverts back to that mean, that average of what a market has done over time.
So Sam Robinson, is a financial author. This would, again, not a huge stretch, so I think I probably agree with Sam. Says the bear market is a fantastic opportunity for long-term investors. Long-term being the key. Yeah.
So again,
I mean, it's kind of that's normal though, right, Phil? I mean, it's a great buying opportunity. It
can be a great buying opportunity. I mean, the reality is this, though: to have a buying opportunity, you had to have cash on the sidelines.
Okay.
So if you've been riding this through and pulling some of the profits off the table, so to speak, as you saw this maybe peak in and starting to get a little turmoil in the beginning of the year,
right?
Having cash to the first author's position is a great opportunity now,
right,
to potentially buy in at this lower point at some stage, depending on when the market reaches that bottom. And again, we'll never know exactly when the bottom was until a month or so after, when they can point backwards, just like they don't tell you when the bear market started until we hit it and say, okay, well, it started back here. So,
right. Yeah. But if you're in the right position, I guess that's the key, Phil, right?
You have to be in the right position to take advantage of it. I mean, if you were fully invested riding this down, there's not really an opportunity because you're in it, right?
Yeah.
So you have to have had cash on the sidelines to buy in.
Okay.
Hopefully you haven't had all your money in those high flyers and you're in retirement right now, and that's been your whole strategy. And now you've ridden it down 30%, like the NASDAQ was at one point, and now you're panicking, wondering what to do. But
all right,
then there's not as much opportunity.
Then there's not as much. That's right.
Yeah.
Forgive me if I get this wrong. Columnist and financial advisor Grant Sullivan maybe, says it looks a little different than usual. It's different spelling. Says to beware of making emotional decisions in turbulent times. Something we certainly talk about often, Phil, and that making those kinds of mistakes obviously are a lot more costly. We've been preaching that for quite a while because we get into this habit of just reacting. And moving things around, and then we cost ourselves more with all the moves, different fees, different ins and outs, and just, of course, then locking in losses, like I just mentioned.
Right. Yeah. And I mean, that's common, right? We're emotional beings. We make decisions emotionally. That's how we react
all day long,
but that's how an advisor can help.
Yeah.
True. I mean, a great example. I just met with a client yesterday, and we don't have a lot of clients that are nervous just again, because of how we position money. They understand we've got risk in that later bucket. This client was focusing just on the later bucket, which is where the risk in their portfolio is. So I had to remind him again, confirm, are we on the same page? This is from an overall risk standpoint where you're at. Yep. Mm-hmm. And they were just looking at the later bucket. And I said, well, we can't do that. You can't look at just that. You got to look at the whole picture, right? We've got to look at the now bucket and the later bucket together, or soon bucket, now, soon, and later, the whole picture, versus just focusing on one piece. That's where the risk is. But that bucket, we're not touching for 10 or more years.
Right.
So we've got time to ride through some of this volatility, and that being said, they weren't even down anywhere near what the market was.
Oh,
but
the panic is everybody's reaction.
Exactly. It's the fear of the unknown, right? We don't know where this is going. No one knows. It's always, okay, are we at the bottom yet? What's the next, when's the next,
and if you've got
shoe gonna drop, so to speak? Are we in a recession? No, we're not there yet, but what happens when? And
and if
now
you've got 100 people that are working with you, just easy number, you got 100 people, 95 of them, they all have a good plan. They all have a good strategy. Everything's there. 90% probably are like, hey, cool. We're good. Right. It's okay to be one or two people that just say, I know that you've done this and I know we're in good shape, but can you just kind of go over it again with me? Cause I'm feeling nervous. That's the value of the advisor.
Absolutely. And that was the point of the discussion yesterday with them, was just walking back through it. Yeah. And I mean, where we ended it is like, look, this is the plan. Yeah. I'm comfortable with where we're at and what's going on. But if it's keeping you up at night,
Right.
maybe we need to make a change, right?
Yeah.
As much as I don't want to, because it's not a good time, I'm going to try to help you through this.
Sure. Right.
But if you're going to lose sleep for the next year, then I guess we're going to have to do something. We're going to have to readjust risk. But let's look at it going forward. And this is when our risk tolerances start to get really tested, right? Everyone's risk. I want something. I want that. The S&P 500. I can handle it. And all of a sudden, it's down 20%. You're like, wait a minute.
I can't handle that.
This is getting uncomfortable. We're not even, maybe near the bottom yet. Looking historically what the S&P's done or any of the markets. Yep. So this is when we really get tested at what is our risk level. And with this client, we walk through some options, and again, as we're walking through them, not really good options. My recommendation as we're working through with this client was number one, and it was the wife. And usually it's one of the two, husband and wife.
I was going to say, it's always one.
Looking at it. She's looking at the accounts every day. And I mean, she's journaling it. She's got it written down and looking at, well, we did, the market did this and we're down.
And that's usually a bad recipe for stress.
Yeah. So that was my first thing is I said, don't look at the accounts every day. If you're going to look at them first, you got to look at the big picture. You can't just look at one, look at the whole picture, and then don't look at them every day. Look at once a month,
Yeah.
Enjoy retirement. Don't stress over this. We've got a plan in place. I'm comfortable. I mean, granted, could things happen? Absolutely.
What is it that
you want to just pull out and, ride it out, then that's up to you. But now you got to determine when you want to get back in.
Yeah.
And that again is one of those recipes for potentially a disaster because looking historically how this plays out, the Delbar study proves this out. I mean, the average investor never performs as good as the market because of that emotion.
Oh yeah, because they're jumping in and moving around and making ill time. What is that saying? Don't stress about. Don't worry about tomorrow or something like that. Worrying about tomorrow does not take care of tomorrow's problems. It just removes today's peace.
Yes,
something like that.
Exactly. That was with her. Stop looking at it and stop listening to the news, right? Because I mean, she's listening to the news all the time and watching and what's going on, and and unfortunately, the news of today isn't the news of yesterday, right? I mean, I always joke. I said, "Where's Paul Harvey when you need him? Give me the rest of the story. I just want the facts." Today, unfortunately, a lot of the news is sensationalized. It's all about advertising. I
think it all is sensationalized. Not
it's not that there isn't fact and truth in there, but there's always seems to be this real stress on making it bigger and badder and work. They don't talk about the good stuff. It's always the bad stuff.
Miners. And what I mean by that is like gold miners. Like we're mining for the nugget of truth inside the story, I think.
Yes.
Versus like just being presented with the facts. It's just like, okay, I'm sure there's some nugget of truth in there, but where? Right. And that's the frustrating part. Let me get to another one or two of these, Phil, before we wrap this up. The head of National Retirement Resource Organization said, if it were me and I was going to declare my retirement and have my party, I think I might delay it a year or maybe two if I could in the current environment. I mean, it's sure. I mean, it's a nice rational statement, but it's also like based on what? Like,
right.
To kind of blanket say that to anybody and they take it, hear it and go, yeah, I should do that. Well, how do you know you should do that if you haven't run any numbers to even see how you've been affected thus far?
Yeah, I mean, exactly. A blanket statement like that is anytime you hear a blanket statement, to me, it's don't pay attention. I mean, it could apply, it might not apply. This very well could apply to that individual that hadn't changed their investment strategy and they were very high risk.
Yeah.
Planning on retiring this year, and all of a sudden now they're down 30%.
Yeah. Or has no idea because they don't even have a strategy.
Exactly. Maybe they've not even looked at it. So, I mean, if it's going to change your picture, you might have to now because you didn't prepare for it to begin with. Mm-hmm. For most people, especially if you've run the numbers and planned this out, we've got clients that are retiring this year and we planned it, but we prepared for that. We already had money positioned in our buckets so that the later bucket, there's more risk. You're going to have volatility. They're going to be down there. We understand that that's long-term. The money we're spending now in the next 10 to 11 years, we're okay. We've got that protected, so they're okay. They don't have to delay retirement. So if you haven't prepared for it, you might have to. But again, don't take it as a rule of thumb. Oh, it's, market's down, I'm not going to retire. I'm going to go ahead and work.
Well, the guy at the retirement resource said I should do it. So
yeah, exactly.
Don't do that. Yeah.
Talk to an advisor, run the math, see maybe, if you haven't changed things and you're down 30% and now you retire, it probably is going to change what your retirement
That's a bad scenario. Yeah.
Long-term looks like. Does it mean you can't retire? No. I mean, you very well could, and you might not even have to change lifestyle. It just might mean you don't have as many extras and won't end up leaving as much to the kids. Or maybe you do have to change lifestyle.
And Phil, that's the point, right? Right. That's the point. Yeah. We're talking about things. We're sharing information when we do the podcast, but we're not saying anything in absolutes or even completely. Yes, we talk in generalities, and we do sometimes make some sort of maybe kind of neutral statements. But it's because you need to see more particulars before you give specific advice through the terms of the podcast or any media delivery. It's like, okay, I'm just delivering this information for you to kind of then take it and internalize it and then run the numbers and the math with your professional before you take that action.
Absolutely. I mean, that's one thing that drives me crazy in our industry is there's so many rules of thumb and, people like this that give these blanket opinions that don't really apply to everyone for sure.
Oh,
if we take the spin that's been put or how our industry, the financial industry works and did that from a medical industry standpoint, I mean, that's malpractice. You don't see a doctor out there saying, "Oh, everyone should, take this prescription."
Right. Yeah. This works for everybody. Yeah.
Once you're over 50, you've got high cholesterol. You're going to have to start doing this. No, some people absolutely.
If I had a pain in my elbow, like this guy, if you took this guy and say, well, if it were me and I had a pain in my elbow, I would take this.
That's right.
You don't know how that's going to react with someone. So that's a great point. You can't just blanket, and even the medical industry does do that to some degree.
To some extent, right. But I mean, they're at least a little bit more, we got to run some tests, right? Look at your situation.
Let's see what's wrong with the elbow before, what's the old Henny, what was it, like Henny Youngman jokes or whatever? Is like, doctor, it hurts when I do this with my arm. Well, then don't do that with your arm.
Do that with your arm. That's right.
That's the only way I could for sure tell you what's wrong with it. Just don't do it. So, all right. Well, good stuff. So we're probably about out of time here. I'll leave us with this kind of Warren Buffett thing. He has a lot of great quotes, Phil, but he has two that kind of contradict himself, really. The most important thing to do if you find yourself in a hole is to stop digging. Okay. But he also likes to say, be fearful when others are greedy and greedy when others are fearful. So in a down market, Warren's made it very clear for years that this is when he starts buying stuff up.
And I mean, again, looking at, you can't compare yourself. Most retirees can't compare themselves to Warren Buffett.
He got a lot of money.
He's got more money than he's ever going to spend.
Yeah, he got a lot of cash to buy up.
Exactly. So, I mean, and he prepares for this. He had been building cash, taking profits off the table. Yeah. He's been investing as markets have come down. Yep. And probably will continue to do that.
Well,
but
he's got
a long-term strategy. He's not planning on living on this money. And maybe with a portion of yours, you can do that.
And that's back to the other guy's quote. It's a long-term thing. If you had cash, like you said, on the sidelines, then maybe it is a great time to kind of add to the portfolio from a buying standpoint. But don't just do it without checking it.
Right. Exactly.
Yeah. Because you don't have, 30 billion or whatever Warren's got.
Right. Or an endless timeline. I mean, it's a company. It doesn't have a life expectancy. It's not an end game, so to speak, that I've got to generate X amount a year and hopefully I don't run out at X, date. That's not what we're talking about.
That's true.
It's the whole concept of institution, right? There used to be this big thing of, the institutional investor did this. Well, yeah, that's great for the institutional investor, but you're not the institutional investor.
The institution. Yeah, exactly.
They don't have a life expectancy. They're going to be there forever. They're not trying to do X, Y, and Z, generate this income.
Yeah,
so you can't look at Warren Buffett and apply necessarily all of that to you. He's got some great nuggets. Absolutely.
Well, so Phil,
especially the last one, be fearful when others are greedy and greedy when others are fearful. Yes. I mean, that works,
Well, what's a Phil nugget as we get out of here for surviving a bear market? Mine's going to be just talk with a professional, right, before
Absolutely.
you do anything, and not exactly groundbreaking, but any words of wisdom that you think as we wrap this up?
Yeah, I mean, be careful with emotional decisions. This is when, unfortunately, a lot of mistakes get made. If you haven't worked with a professional before you jump in and do something, talk to a professional. And make sure that relationship works, right? It's if you're not comfortable with that decision or that discussion,
right,
talk to another one. Not that you're trying to get one that tickles your ear, but I mean, you've got to be on the same page and they've got to be able to communicate.
Yeah.
But don't make a harsh decision. That's the worst thing you can do is just, all of a sudden, I'm going to sell it all and I'm not coming back in.
Panic.
There's a lot of people that did that in the pandemic and they never got back in, and look what they missed. So
I like that. Not one that just tickles your ear. One that
because you'll find one that it sounds great. Everything they're telling you is rosy, and
or confirming everything you want to hear. Yeah, exactly.
Right.
Yeah. Well, good stuff. So, no ear tickling. So
That's right.
We're going to get out of here this week, but best advice on surviving down markets and things like that is having a strategy, having a plan for you. So reach out to your advisor, find an advisor, as Phil just said, talk with one, talk with two, talk with three, whatever the case might be, but find the professional that works for you, that resonates with you. Reach out to Phil if you'd like to, stop by, subscribe to the podcast, whatever the case might be. philstaxhacks.com. That's philstaxhacks.com, or call him at 248-888-7530 if you'd like to talk with him, get on the calendar, whatever the case might be. But do yourself a favor, do your retirement a favor, start talking and trying to find the right professional for you. And we'll see you next time here on Phil's Tax Hacks and Other Retirement Facts. Thank you, my friend. I'll catch you later.
Take care.
All right, we'll see you next time. Folks, don't forget to subscribe to us, Apple, Google, Spotify, iHeart, and Stitcher. We'll see you next time.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.